Glad to know you're still with us. Now to the first conversation on the show today. The Nigerian government has introduced a new domestic dollar bond as part of its strategy to bolster foreign exchange reserves and diversify funding sources. While the bond offers potential benefits, concerns have emerged about its impact on the naira exchange rate and the strategy's overall effectiveness. Now let's dive into the details of this new debt instrument and analyze its potential implications for the Nigerian economy. To do this, Tajudeen Ibrahim, Director, Research and Strategy, Chapel Hill Denham, joins me. Thank you for joining me today.
It's my pleasure for having me.
Right. The initial announcement said these issuance would come in Q2. Here we are in Q3, and though we're told it's this month, we do not seem to have clarity on the date yet. Is it that the government is still building the confidence it says it was trying to build?
I think it is more of the required regulatory approvals, and it is more of identifying the actual investors that will invest in the investment security. You have to bear in mind that this is a new product in the market. We have not had it before in the market in the country, so I'm not surprised that they have not come to the market after that announcement. But I reckon that before the end of this month, or possibly in the first week of next month, we will see them in the market.
Right. The devil, they say, is in the detail. I mean, we're looking at a 5-year tenor security here, open to citizens and non-citizens, resident or not, including institutional investors, though it said qualified institutional investors. We'll probably get to that later. Now, interest is to be benchmarked against comparable FGN Eurobond yields. What rate are we looking at here? I mean, give us an idea of the data.
I think the rate we should be expecting is something in the high single-digit level, because the corresponding instrument by the federal government, that is the Eurobond, that is maturing within the next 5 years, basically maturing in 2029, has a yield of around 8 to 9% within that range. So if we are looking at a new instrument by the same federal government in the same dollar-denominated currency, then one should be expecting the yield to be around 8 to 9%, which to my mind is a compelling one compared to what investors get in advanced economies that are not more than 4%, 4 to 4.5% in terms of yield on similar instruments. And also, I think we have to bear in mind that Nigerians that have dollar in their domiciliary accounts will find this instrument beneficial in terms of return, because we have to recognize that dollar domiciliary account balances do not generate any return for the account holder. Rather, you even pay the banks for keeping your foreign currency, for you in their vault. So I see this instrument as a good one for investors, particularly retail investors in this regard, considering that dollar balances in the banks do not generate any return. And if they invest in this 5-year dollar-denominated bond by the federal government, they will be getting a yield of around 8 to 9% based on what we are seeing in the market. But there is a bit of a concern around other assets in the market, because we have some dollar funds in the market. Those ones may offer more compelling yields than the federal government bond, in my view.
You know that the federal government is targeting $1 billion, and in fact, about $2 billion at the end of the day. However, this particular auction comes at a time when 5 of Nigeria's Eurobonds were ranked among the worst performers. That's in a Bloomberg index of emerging and frontier sovereign debt. I know you've talked about how this is very good for investors, but that's more risk, and with that comes higher interest. Maybe good for investors, like you said, but for the issuing country, maybe not so good. What do you think?
So for the issuing country, I think, for us to issue at single digit, it is not a high cost, because I recognize that the cheapest sort of dollar-denominated bond that we have in issue currently is around 6 to 6.5 5%, which appears to be like, the cheapest. So if we are coming to the market and we are offering investors, single digits, even though it is high single digits, I think it is not a bad deal at all, considering also, that this is a new instrument in the market. So you need to give that incentive for investors to be interested in investing in it. I was expecting the government to come up with the normal Eurobond, but this dollar-denominated local bond is a new product. So there is need, for them to encourage investors. And I think, substantially appealing yield is one of the, ways by which, investors can be encouraged to participate in the offer, in my view.
All right, I'll come to one of the risks to that anyway, but then several concerns have actually been expressed so far, ranging from fears that this particular move could exacerbate pressures on the naira, fragment the market, and also elevate the cost associated with naira securities. I mean, this is not all. Isn't this something to be worried about, actually?
So it is something to be worried about, honestly speaking, but there is more of an upside, to that than downside. I said it earlier that the target, to my mind, largely speaking, are the dollar balances in commercial banks that Nigerians are holding. Those dollar balances are well over $25 billion, are based on the latest data by the CBN. And what that implies is that out of the about $25 billion, the government, as we speak, is targeting what looks like, $500 million to $1 billion out of those, those balances. That is one on the one side. On the other side, I recognize the fact that they are looking for, Nigerians in diaspora to also, invest in the assets. So I reckon that it will not be that difficult, for the government to get up to the volume that they need, considering all those channels of investment, in my view. And finally, I also recognize the fact that Nigeria has some dollar funds in the market, and those dollar funds, to my mind, will also qualify to invest in that asset. So I think in the early days, my sense is that it is positive for the country, particularly if the funds are invested in infrastructure that will deliver economic value over the medium to long term. That is when, to my mind, it makes economic sense to the country. For the investor, I have said it is about the return, and I reckon that the investors will find the return appealing. But for the country, the fund must, or the proceed must be invested in what will lead to an improvement in economic growth and development for us in the country, particularly capital expenditure, and not so much of recurrent expenditure, in my view.
Interesting. Let's look at some of the fears, that investors or a lot of persons have expressed. For example, IMF. IMF actually advised the CBN to develop a foreign exchange intervention framework to smooth excess naira volatility. That's looking at the shallow nature of the forex market. I know you've tried to sort of talk about the positives and all of those things, but really looking at this, which the IMF is advising, what do you think? How can we make that work?
Where there's a problem, to my mind, is when Nigerians now go to the dollar market to demand, for US dollars to participate in the offer. I think that is where the problem will come from. I believe that at that point in time there will be an undue pressure on the naira, and we may see the naira trade at much higher levels without the necessary fundamentals supporting it, largely just because there is demand in the market by by people that want to invest in the assets. And I think around dollar inflow, I think we should also bear in mind that debt is not the only channel through which we earn US dollars. There are many other channels, and number one of them is exports. Our export is one major channel, and I reckon that we have been seeing some improvement in that. Particularly when you look at our current account balance, we have maintained a surplus in the current account within the past sort of 3 to 4 quarters. And the current indications I am seeing are pointing to sustained current account surplus in the second quarter of this year. Not necessarily because of substantially higher exports, but more of a slowdown in imports. We also need to embrace what I call import substitution, and this largely speaks to what we can do in the oil and gas sector, where, for instance, the government is considering selling crude oil to local refiners in naira. I believe that is going to save us some money. The government estimates that it will save us about $7.3 billion. But I also noticed that the total import bill in 2023 that is traceable to oil product is about $20 billion, which means if we look beyond PMS and we take a look at the entire oil sector, whatever we import in that space, if we look at it, on a holistic basis, we can save up to $20 billion per annum as a country. So, but effort has to be directed towards this from the fiscal authority and also from the monetary authority, in my view.
Well, talking about exports and all of those, you probably want to also look at the oil and gas industry, which is the highest, the highest generator of, if you can permit me to use that word, that's like the sector that sort of helps Nigeria with, having more forex and all of those. So talk to us. What do you think about that? Do you think enough is being done to actually put, some sort of, do you think enough measures are actually put in place to help that particular sector?
I think the measures being put in place are not enough. Honestly speaking, I reckon that the government can do a lot more given the importance of that sector. And if you look at the sector, we still have a lot of challenges around, number one, production, and that has limited our ability to benefit from the elevated crude oil prices globally. Number two, what we are seeing about, in the NNPC, let me just be straightforward in this case. What we are hearing about NNPC, to my mind, is not the best. We need a cleanup of NNPC as a whole. When we have a cleanup, you will have clarity around the availability of crude oil to be sold to local refiners. You will have the ability for you to stop as a country importing petroleum products from overseas. We have our local refineries that are owned by the government. Till now, they are not working, and a lot has been spent on them. We need to do a complete, revamp of that NNPC. That is when we'll be talking about us benefiting from being an oil-producing country. Otherwise, it will still be like the same story all over again.
Right, thank you so much, Tajudeen Ibrahim, for your time and thoughts on the show today. I'm afraid we have to go because we need to join a live procession in Abuja. Thank you so much for your time.